Our next presentation is beginning now. National Multifamily Economic and Market Outlook, featuring John Sebree.
How's everybody doing? My name is John Sebree. I'm National Director of Multifamily for Marcus, Millichap, and IPA across the country. And this kind of economic overview, doing this a couple of years ago was kind of easy, right? Things weren't changing that much. A lot more uncertainty right now, a lot more, as you're looking at metrics and trying to figure out what direction things are going and where they're going to go. We had a panel up here before, which was fascinating. And listening to them talk, and they're very much kind of boots in the trench, feeling things every moment of every day. And Rishi gave some great commentary on how his perspective on buying deals, and Alan talking about things from a financing standpoint. I'm gonna open it up. I'm gonna go to about more of a 30,000 foot level. So some of the things I'm gonna say have a little bit different perspective than where they were coming from. Not disagreeing with them, just a little bit different perspective. But want to take a step back, kind of look at things from a large economic perspective, and let's paint a picture on kind of where we are and how we got here. So we all know we're dealing with a lot of inflation. So why are we dealing with inflation? In large part, we've increased the money supply into our system. So you can see on the chart, during the pandemic, the beginning of the pandemic, they put money into the system that was the equivalent of 26% of GDP. Now, it was necessary. They had to do it. Everything was shut down. But by comparison, during the great financial crisis, they put in money that was the equivalent of 6%, right? So that's an enormous amount that has gone into the system. And once again, it was necessary. But then the question is, you don't know how much is enough and how much is too much. When you compare what's happening with interest rates, so they put that into the system, and then inflation starts kicking in, right? So now what do we have to do? Well, we have to start increasing interest rates. We have to start pumping the brakes on that a little bit. And probably waited too long to start doing that. Not probably, they definitely waited too long to start doing it. Everybody remembers how transitory everything was. But they've increased the federal funds rate 11 times since the start of this. You've got it, and we had a Fed funds meeting last week, and Powell decided to hold again, which I think was a smart thing to do. So that's 2 holds in a row. Now, at the same time, and there's a question: will he increase? If you notice, he keeps holding a card. There might be one more, right? Because he doesn't want to state definitively there's not going to be another one. But he's just trying to keep that option open because you don't know how metrics are going to be coming back. And it's a delayed reaction. So we've increased these interest rates, but we don't know yet how much impact that's really going to have on the consumer and on the economy. The other line is the 10-year Treasury. So the 10-year Treasury is kind of interesting because, through kind of 2021, it stayed fairly stable, and then it had a run up. At the beginning of this year, the 10-year Treasury was staying between kind of a 3.2, 3.4 range, and it was fairly consistent for, really about 90 days. And as a quick aside, on our IPA platform, we had more BOVs in May than any time since before the pandemic. And really the reason was interest rates had kind of stabilized. Powell is indicating he's slowing down the increasing of the federal funds rate. So at that point, buyers and sellers, that bid-ask spread started coming back in, and people started saying, okay, now let's go ahead and take a look at it. Well, then what happened? They increased the debt ceiling. They have to sell a tremendous amount more treasuries. And I think on May 10th, it was at 3.4%, and then it rung the bell at 5. So 160 basis point increase over that period of time. It's come back down. I think it closed Friday at 3.6. I looked at it an hour or so ago. It's still holding at about 3.6. But still, that's a huge change. And when that happens, that widens that bid-ask spread from an apartment standpoint and makes it very difficult to buy. Because what is my interest rate going to be? It's changing every single day. You know, lenders are struggling with that. Buyers are struggling with it, as well as sellers. So as we bring this in. And we look at what's happening with inflation. We've got CPIs at 3.7%. It's up from about 3%. It kind of jumped up a little bit, but I think it'll keep trending down a little bit. The high point was 9.1, so that's pretty high level. Core CPI was a little bit more stubborn. It was a little bit harder to have it start dropping down. It's now come down to 4.1. I really think over the next couple of years that core CPI will come down, continue to come down a little bit. Powell continues to say he's shooting for a 2% inflation rate. Personally, I think that core CPI over the next 12 months gets down to 3%, and I think he changes his tune and goes to about a 2.5%. Right, maybe a 2 or 3. I think it's going to be really difficult to get that back down to 2% with where we are right now. And I could be wrong, but just kind of my opinion on that. And then once again, you can see how the 10-year plays through that and how much of a run up that's been. And you know, everybody's trying to figure out the same thing. How long we're dealing with uncertainty. How long is this uncertainty going to last? Another factor you've got to look at is employment. And so you've got 3.7 more jobs in the economy today than what you had prior to the pandemic. So our economy has continued to grow. You've also got 3.2 million more people. You've got 3.2 million more job openings than you have people that are unemployed. Now, that number's down from 6 million before. So what's happening is the number of people that are the number of job openings is continuing to come down. And if I'm projecting this over the next 6 or 8 months, I think that continues to come down further. Unemployment's only at 3.8%. And what Powell can't say, and he's actually been questioned on this, but he won't say it, but what he wants is he wants unemployment to go up, right? He needs unemployment to go up. Keep in mind, it's been at 3.2, it's up to 3.8 right now, but historically, 5% unemployment has been full employment, right? So we've been trending much, much better than that. The other problem is, and part of the reason that Powell is pushing for this is, if you have 3.5% or 3.8% unemployment, it's really, really hard to get workers. So what do you have to do to get the workers? You have to pay them more money, right? How many people have had to dramatically increase the cost of paying the maintenance guy over the past couple of years, right? So, the reason is, if you don't, they'll go somewhere else. And by increasing the cost to the maintenance guy, that's an inflationary pressure. So, in my opinion, part of what needs to happen is that unemployment rate will go up a little bit, and that wage growth number will come down, which once again will help our inflation a little bit. When we stay on jobs and we look at, I'm not used to the monitor being up here, so my apologies. But when we look at jobs over the past 12 months, so, and I did this by percentage, not gross jobs, but where were the most jobs created over the past 12 months? Percentage-wise, you've got Jacksonville, Dallas-Fort Worth, Vegas, Charlotte. It's a lot of the markets that you would expect on the left side of the screen. So we've had, once again, 3.1 million, almost 3.2 million new jobs. The markets actually fall into a couple of different categories. You know, Dallas, Charlotte, Nashville, Miami, never really had a huge setback from the pandemic, right? They kind of kept moving on. Whereas Orlando, for example, had a huge drop-off and was a little bit later to come back into the market. Boston and Philadelphia, once again, they were very, very slow to start coming back into the market. So when you look at this, you just got to realize it's a snapshot, and some of those lines are going at, you know, kind of in different directions. The bottom 10, Denver's at the top of the list, which really Denver had huge employment growth in 21 and even at the beginning of 22, and then they've dropped off. I think that's temporary. Denver's a very diverse economy. I think that's just a pause, and then it'll move forward. And then you've even got, for local people, you've got West Palm Beach and Fort Lauderdale. I always get a kick out of that because those are markets that really don't depend on jobs, right? You've got an importation business. You import rich people from the Northeast and bring them down here and let them spend their money. So it works out pretty well. But employment in West Palm and Fort Lauderdale is not nearly as critical as it is in a lot of other markets. So now let's talk new construction. And this is the part of the industry that does cause concern. In 2022, we delivered 320,000 new units. In 2023, we're going to deliver about 420,000 new units. And in 2024, in the pipeline, we're going to deliver 480,000 units, okay? Now, that's more new construction than any time since the 70s. The other part of it is that if you look at the 6 years prior to 2020, the average was about 280,000 units a year. That means that in 2024, we're going to deliver units that equate to a 41% increase over that 6-year average. That's a huge jump. That's a very big jump. Vacancy has already started to go up. It was down as low as, I think, 2.6%, projected at the end of in 2024 to get up to about 6%. So that's a pretty big jump. And when we look at where these units are being delivered, a lot of it is what you would expect. You got Dallas, Fort Worth, Atlanta, Houston, New York, Austin. You've got to look at the number to the right, the percentage. So what that represents is that is the percentage, the units that are being delivered, that is the percentage of existing stock that is being delivered, right? So New York City is delivering a lot of units, but it's less than 1% of stock. That's not really going to move the needle. By comparison, you've got Charlotte and Austin that are delivering 6.5%. A little bit more aggressive. Austin, 8%. Think about that. Take the entire market, an 8% increase in total number of units in a single year. That's a pretty big jump, right? On the right side of the screen are the markets that are delivering the least number of units. You can put those into two categories. You have low-income Midwestern markets and high-income California markets, right? So they're both on that right side of the screen, but they're on the right side of the screen for totally different reasons. West side of our Midwest is doing well. You can kind of divide the Midwest to the upper Midwest and the lower Midwest, but for the most part, those markets are doing okay. They're just, and especially the lower Midwest, but they're just not bouncing back quite as much as a lot of the others. When we look at new construction on a map, you can see really what this comes down to is the green and yellow. Really, the green are the markets that are delivering the least number of units as a percentage of their existing stock. Yellow is kind of moderate, 2 to 3%. Nothing to be overly concerned about. Quite frankly, red are markets that just have a lot in the pipeline. I don't want to wave a flag and create a scare tactic. I'm not saying that these markets are headed into the abyss, but it's going to be tough for a couple of years, right? That's a lot of units that you have being delivered, and we all know that you deliver a lot of units at the A level, and they got to start pulling from the Bs, and they got to start pulling from the Cs, so that is a little bit of a domino effect. I think the demand in the Cs is strong enough that those will maintain pretty good. But once again, those are just kind of some of the markets that we're looking at, we're keeping an eye on. And again, we haven't even delivered all these units, right? I mean, there's a lot more units that are going to be delivered over the next 18 months. So even though we're starting to get soft, this stuff's already in the pipeline. And there are some of these markets that are going to continue to be a little bit soft. Now, the flip side of that is that you have all of these units that are in the pipeline that are getting delivered, but there's almost nothing that's being started new, right? So if you look at the total number of units that were started on a quarter-by-quarter basis, the second quarter of 2022, construction was started on 178,000 units. Third quarter of 2023, 39,000 units. That's more than a 75% decrease in the amount of new construction starts. And my prediction is the fourth quarter is going to drop even more, right? And the first quarter of next year is going to drop even more. So what we have is we have all of these units that are in the pipeline that are going to get delivered, and once they get delivered, the market, some of those markets are going to be soft. And then as that gets absorbed, that pendulum is going to swing back with a vengeance, right? Because the economy continues to grow. Our economy is fairly strong, fairly stable. But as soon as we occupy these units, then there's no new units coming online. And that at that point, we're going to start seeing rent growth coming back very strong. We're going to see occupancy rates go back up. Now, I don't know when that is. I mean, we're looking at 25, 26 is probably when we are. We've got a couple of years here where it's going to be a little bit tough. Another thing to keep in mind is that if you go back to this slide that had the top 10 markets for delivering all those units, and you add up all of those numbers, those 10 markets represent almost 45% of all of the units being delivered. So this isn't evenly spread throughout the country, right? It's very concentrated in a handful of markets. Another aspect that, and this is sometimes I'll have like 3 slides in a row that are on one thing, and then I'll just have random slides bounce in that are interesting talking points. One of the things we look at is the affordability gap. And the affordability gap is the cost differential between renting and owning in a market. And you know, you can see 2013 it was $41, right? Which is kind of interesting. Today that number's almost $1,300. By comparison, in New York City and San Francisco, it's $9,500. So this is a national average. But the important aspect of, and there's a couple of things that are coming into play here. Part of this is that you've got a supply-demand imbalance, but obviously a big part of this is just interest rates have gone through the roof. And as interest rates have gone through the roof, it's become more and more difficult for people to buy single-family homes. That's a big jump, right? If all of a sudden you're going to go from renting to owning, and you've got to bake, you know, and it's $2,000 more a month, that's a huge leap. So what are you going to do? You're probably going to stay in your apartment for a longer period of time. So the benefit to the people in the room are that you're probably going to have renters for longer, right? That's probably not going to change an enormous amount. And not only that, you just don't have that many single-family homes being built. You definitely don't have single-family homes being built for first-time home buyers, not like they used to. Another aspect on the rent side of it, I thought this was very interesting. So you had this is rent growth, annual rent growth. A and B quality properties had a high point of 16% in 2021. So they both had 16% rent growth. And now they've dropped back down. And A is at 2.6% and B is at 1.5%. The C's are interesting because it's on a different trajectory. And so the C's hit a peak of only about 12%, but about 5 quarters after the peak of A's and B's. And that's now down at 6.2%. Now they're all falling, and if I'm going to predict, they're going to continue to fall in my opinion. I mean, I think that rent growth number comes down because we just have so many units coming on the market, and the reality is our economy is slowing a little bit. I don't know how much. I do think that the B's and C's will remain a little bit more resilient than the A's. I just think that new construction on the A's is going to create some softness there. But I think people that have C quality product, you know, you want to keep your renters, right? You want to hang on to them. And quite frankly, they don't have a whole lot of options either. So I guess that's a pretty good scenario from that respect. Another interesting part is you look at the total amount of increase since 2009, which is a pretty big number. This is looking at total rent growth since pre-pandemic, and I just thought it was kind of an interesting perspective that you've got Southeast Florida, Tampa, Inland Empire. A few of these markets have had as much as 40% rent increase since prior to the pandemic. And then you've got other markets that go down, and the yellow and the red have really had the least amount. Red has had none, which is San Francisco. The yellows had very little. Now, there's a couple of different aspects of these. And one of the big parts of this is that the yellow markets were also very, very late to come out of the pandemic, right? I mean, we're in Florida. You guys didn't even have a pandemic. But in San Francisco, there's still people hiding under their bed. So it's an interesting social aspect of this, of how that is different in different markets. But I think there's upward pressure on rents in the Bay Area. I was there 2 weeks ago and meeting with a bunch of clients. That will start coming back a little bit, but it's also a very supply-constrained market. Another aspect that we look at, I think this is a critical view, and I don't think as many people look at it as maybe should, but we look at the young professional, or young age cohort. So this is the 20 to 34-year-old age cohort. And it's critical because over the next 5 years, this age cohort is going to decrease by 1.36 million people. And it's also critical because this age cohort is the group that really fuels an economy, right? Because what do you do when you're that age? Well, you start making a lot of money, and then you spend everything you make, right? You go to dinner, you go to Target 4 times a week, you rent an apartment, you buy a car, you try to buy a house, and all this stimulates the economy. So it's critical to see where these people are going to be. The other part of it is that our young generation is more mobile than they've ever been before. So all of a sudden, they don't think twice about moving for this opportunity or that opportunity. So I did this on a percentage basis. So on the left side of the screen are the markets that are going to gain the largest percentage or have the largest percentage increase in this age cohort over the next 5 years. Austin, Salt Lake City, Dallas, Houston. Austin at 9%, that's huge. The 4 metros of Texas are in the top 6. That's also a huge number. On the right side of the screen, you see the markets that are projected to lose. And so you've got New York, Detroit, Cleveland. You've got, I think, 4 of these are Midwest. You've got 2 or 3 of them that are California and Northeast. It's interesting, so many of the metrics I look at, when you look at markets that are expanding, growing, have a lot of runway, and markets that are moving more slowly or not expanding, the markets that are not expanding nearly as much seem to fall into 3 regions. It's California, it's Upper Midwest, and it's Northeast. And it doesn't mean, look, I'm a huge believer in New York. New York comes back because New York always comes back. But I'm looking at numbers in, no disrespect to anybody here, but Detroit and Milwaukee and Minneapolis, and some of these trends are a little bit concerning from a long-term perspective. This is again that young adult migration, and just looking at it on a map. As you can tell, I like maps with pretty colors. It makes sense to me. But I had talked about kind of that Northeast, Upper Midwest, and West Coast. You can see that for the red, and then the greens are the markets that are having the best expansion of that. And again, it's kind of what you would expect. It's the markets that are kind of working with more of a tailwind than a headwind. Let's talk about financing a little bit. The previous panel was talking about debt, and once again, all 4 of them are very much boots in the trench, kind of working on this every moment of every day. I'm going to take a step back and look at it from a large perspective, because there are definitely some people that are struggling, and that is going to continue, and we're probably going to go farther down before we start going back up. One of the questions I've had from people is, yeah, but is the real estate market going to take down the banking system, right? That's a question a lot of people have, is how bad is this going to be? And the answer is, I really don't see it. I don't think that's going to happen. So here's what you have are bank maturities on an annual basis, and it also breaks out the different kind of product types. So you've got $728 billion in maturities in 23, and you've got another $659 billion next year. I may have said trillion. Billion next year. The multifamily side of it is 180 billion this year and 250 billion next year, I think. So that's kind of how that plays out. I'm not saying it's insignificant, but if you look at banks and the total amount that they have out, it's about 24% of it is commercial real estate. Now, the other thing that a lot of people are saying is, yeah, but office is going to hurt us. You know, the office loans and the banks that are doing office loans, that's what's really going to bring it down. Office makes up 14% of the bank's real estate portfolio, and the real estate portfolio makes up 24%. So 14% of 24% is only 3.6%. So I don't think that's going to be a catalyst that really takes it down. Again, we all know there's people that there are going to be some pain points, but I also don't think there's going to be blood in the street, right? The one thing that I hear from more investors right now than anywhere else is, yeah, but I'm sitting on a lot of dry powder. So when these deals come out, I'm going after them. Well, you know, you and the huge line of people that are surrounding. I mean, there's a lot of that equity out there that's looking. One of the conversations that I engage in a lot is just, where do we think cap rates are going to go? And this is kind of coming from an institutional perspective, but I think the institutional perspective is important because I think it influences what's happening at the private capital level. U.S. Treasury right now at about 4.6%. Again, that is down from 4.9% over the past couple of weeks. Average cap rate 5.2%, and that's a national A, B, and C quality approach. What has to happen is that delta needs to be greater than it's been, right? So if I would have shown you this slide 2 weeks ago, it was 5.2% and 5 or 4.9. So it's expanded a little bit, but that delta has to be greater because there has to be a risk allocation to going into apartments to be able to get that return. What ends up happening is that the institutions, and I was at a conference in Boston for real estate pension funds a couple of weeks ago. The institutional money is 100% on the sidelines. I mean, they are absolutely not doing anything right now except sitting on their hands. Once the market reaches a point that money starts coming back in, it'll come back in with a vengeance. But I do think we're probably another year and a half out from that. Another aspect of this is the delta between 10-year Treasury and average cap rates. So you can see that, in 2020, we all did a lot of deals. It was a 410 basis point spread. And today, that has dropped down to a very low number. I didn't update this slide. That's the only problem about doing these, is I get the slides done like 4 or 5 days in advance, and then the market changes. But once again, that delta probably needs to be a little bit higher than what it is in order to get people back in. The other hindrance is just the uncertainty, the fluctuation in what's happening in the markets. The flip side of that is that there's just as there's a lot of institutional money on the sidelines, there's an all-time high of private capital sitting on the sidelines. $237 billion of private capital sitting on the sidelines right now. So if I'm looking at this and I'm going to guess how this plays out over the next couple of years, I I end up in conversations with our investors and our brokers on a regular basis, and my argument is always the same, which is, okay, in every downturn, in every correction, there's opportunity. So where is the opportunity? And I do think that at some point in the future, this private capital is going to start flooding back into the market. And again, we're not there. Interest rates need to stabilize a little bit. That bid-ask spread needs to come in a little bit. In other words, we probably need to go through a little bit more turmoil before we hit stability. But once we hit that stability, this private capital comes back in. I think that the institutional money comes back in because the fundamentals are so rock solid. I mean, at the end of the day, when I'm talking to people, I'm like, so are you getting out of the business? No, I'm not getting out of the business. Well, are you, what is your approach? Well, I'm waiting to buy. I've got money, I'm waiting to buy. Well, why? Well, because the fundamentals are so strong, right? We have a housing crisis, which is a terrible thing for a country to have, except for the fact that we own apartments, so it's working pretty well for us, right? So that's kind of, I mean, I have told a couple of people recently, I'm like, if you're underwriting a deal, and if you believe in it, I wouldn't go running around and just buying everything. But Rishi made a comment on the previous panel. He said, basically what he explained is, he's defined his box. This is where I'm going to buy. And if I find a deal in that area, I'm going to go after it. Now, you might be looking at negative leverage for 12 or 14 months, right? But the other side of it is, I sincerely believe, and maybe it's not until 25 or 26, but once this capital starts coming back into the market and things stabilize, we're going to be back to 20, 25 offers on every single deal, and everybody's scrambling around trying to figure out how to put up hard money and no due diligence and everything else. Once again, I think the fundamentals are that strong. I don't think we're going to see interest rates get back down to where they are or where they were, but we don't need interest rates to be low in order to make deals happen. We just need there to be stability, and we need to have that long-term positive return outlook for it. So with that, I've got a few minutes left. I don't know if anybody, I think that was it. We don't want to see that. There's my high school picture. If anybody has any questions.
So the money's going to find itself back in the market. What's going to be the trigger? Right now we're sitting on the sidelines. And it doesn't look like anything's going to change the price. Interest rates and fundamental.
Right. So his question was you've got all this money on the sidelines, what's going to be the trigger for it to come back? Look, the money is on the sidelines, and it's like waiting. It's waiting for an opportunity. Somebody's going to take a picture of that. That's going to be funny. But it's looking for that opportunity, and it's waiting for the opportunity because it's looking at it saying our fundamentals are really, really good, right? My 5-year outlook is really strong. My 24-month outlook is unstable, and I can't quite get a handle on it. But that won't last forever. So you are correct. Interest rates are volatile right now. The money's not going to come out, before the end of the year. I don't know that it really jumps off the sidelines in 24, because I think we're still going to have some unstable factors coming into play. And I think interest rates, the reason that we've had the run up in the Treasury, or in the Treasury, is because they've dramatically increased the amount of Treasuries they're selling, right? But that's not going to last forever. That's going to probably over the next 3 or 4 months, that's going to pull back, and that 10-year is going to come back in a little bit. The other thing they're doing is they're selling a lot more 30-year Treasuries, a lot longer-term Treasuries, and less shorter-term Treasuries, which should stabilize the long end of the curve. So what's going to cause it is stability. We don't have the stability now, but once we do, I think that money starts jumping back in. So, anything else? Yes?
When do you think insurance rates will come down?
Say it again?
When do you think
Insurance rates? Wow. That's been a kick to the head, hasn't it? I don't know. I mean, my speculation is that if you look at insurance rates over an extended period of time, they will have jumps, and then they'll come back down to about half as much as the jump was, and then it'll be stable, and then another event will happen, and it'll jump up again. So I don't know, when's the next forest fire, hurricane, earthquake, all of that. The insurance industry is a competitive industry. So what will happen is if we go for a period of time without any major losses, then more insurance companies will start being more aggressive, and they'll start getting back in, and that'll bring the price down. But it's a cycle. It really is. I mean, if you look at it over long term. So, anything else? Say it again. So his question was, what makes me think the fundamentals are going to remain rock solid? Because we're a brokerage firm and we need them to be rock solid in order for us to make money. Because we have a housing crisis. Because we're not building nearly enough new dwelling units. And the other part of that is that if you look at 05, 06, and 07, and you looked at all the dwelling units that were delivered each year, multifamily represented about 8% of it, okay? The last 3 years, multifamilies represented almost 30%. So what's happened is not only are we not building enough dwelling units, but now we're relying much more on apartments as opposed to single family. And the reason for the single family is they changed, the Dodd-Frank bill came in after the great financial crisis, and they looked at the housing crash and they said, we're gonna make sure this never happens again, and they did, right? But they may have cut a little bit too deep. So I can't see a scenario. I mean, what would make our fundamentals fall apart is vacancy, right? Now, well, and I even said rent growth is coming down, and rent growth could go negative, right? And we've got a couple of years where it's going to be difficult, but we also have all of these units that are being delivered in 23 and 24. And then there's nothing behind it. So when I say long-term fundamentals, I'm looking, I'm 7 to 10 years out. Our next couple of years are going to be a little bit tough, though. So, Henry.
You didn't touch on the macro picture. We are the big war going in the Middle East.
Right. You know what? Yeah, and that's Henry, you promised you wouldn't heckle me, and asked. I said you promised you weren't going to ask me a tough question. No, his question was, look, we've got a lot of global uncertainty, and you are 100% correct. And I usually mention that in this. I didn't. That's a wild card. I mean, that is an absolute wild card. And you've got the Middle East, which is truly horrendous and frightening. You've got Ukraine, which is interesting from another perspective in that they're running out of money and they're running out of soldiers, and nobody's as interested as they were before. You've got China, which is also creates a lot of uncertainty. And here's the other side: is you haven't had anything happen on our soil, which could happen, right? And we all hope and pray that it doesn't, but it could. And so all of those things, you're absolutely right, create an enormous, and I can't put it on a chart. I can't, that's the problem with that, is there's so much uncertainty with that that it ends up, it ends up being the wild card that takes it one direction or another. The other part of it is, as the playground monitor for the World Playground, we end up having, being obligated to fund a lot of these other things, and that could certainly have an impact on our deficit, on our bottom line as well. So, all right, looks like I'm out of time. I'll be around today, but thank you all very much.